So in this particular presentation, live webinar, I am going to describe the pair trade logic using the beta decoupling method. So we will go deep into the subject. So what is beta decoupling, how it occurs, how it gives a trade opportunity. So all those things we will be discussing step by step, and this session will be recorded. It will be shared with you. So you have been invited to this session being a free member of this SF free crypto strategy group. So if you have come from this group, then you are already subscribed and you can add your friends to this group. So this group we have just started few days back, and those who are the serious crypto traders, many serious crypto traders have joined this particular group. You can also invite your friends to join this group. You can add them to this group, and whenever I'll give the recording of this particular event, in description I'll be giving the link to join this particular free group. So what we give here, crypto is a very complex instrument. It is not a easy instrument. It is not a, you can say, simple instrument. It is having lot of complexities in it. First complexities, it is a trading in different currencies. So sometime in USD, sometime in USDT. Sometimes the exchanges used to fix their own rate for the conversion, and these coins, whatever we are, Bitcoin or Ethereum we are trading, they have different categories and futures not having any expiry because they are perpetual futures. It has funding cost, lot of complexities are there. Similar way, all coins also having based on their utility, based on that category they belongs, based on the projects they have. So they are being categorized. So you cannot invest in this based like your stock or mutual fund. So you have to go deep into that coins arithmetic to know what is that coin is, what they are doing, what is the utility of that things. Then only you can able to choose that coin. So here what we are doing in this particular group. So here I am suggesting you that certain quality coins to accumulate. I am giving you specific option strategy to do. I am giving you specific articles wherein how you can do some arbitrage type of trades, how you can harvest the funding cost. All these things we are doing here, and here complex daily yield strategies we are going, because we are meeting with one instrument which is having a volatility beyond our imaginations. So it is 60, 70, 80% volatility is involved in this particular instrument. So volatility, whenever it increases, it gives you two kind of things. One, it is a challenge. Second, it creates a huge opportunity. So all these things is being tested here. So what I will suggest you, if you are a member of this particular group, if you are not participating in trade also, at least 6 months you observe it, how these investment cycles are going on, how these trades are working. So you can keep on observing these things for a 6-month period, not 1 day, 2 day. So post that, you can get a grip over that, how to work on this particular segment, and slowly you filter out or pin down specific methods which is easy for you and stick to that method and work on that. So that will be a great idea to trade on this. So we are talking about the today's session. I'll be talking about the pair trade logics. So again I will say, those who have not joined the group, in the description of this video, whenever I upload, I'll be giving the link. You can join this group. Though we have other groups, but I cannot put that invitation always in all groups. So this will be an exclusive group for the crypto traders. So we have a fantastic software also. So this software also currently we are giving free to our referral clients. It is not free to all. So those who are joining us through referral, so we have referral with the Delta Exchange and CoinSwitch. Those who are joining to our group through our referral, they get our software free of cost, and they can utilize this software for intraday analysis, for option analysis, for option strategy, many things you can do. So this software is also continuously it is evolving, and it is working on that. So this pair trade also what you are going to learn today, this is also programmed in this software. So we are going to learn this method today. So it's a great day, and once again good evening to all of you. So you'll be learning many good things of the pair trade logics, how to work on that. So I'll start the session for the day. Trade in the capital market. This is a particular method of pair trade is being innovated by me. So myself is Soumyaranjan Anna. So this is my native state's name or family name. So here you can say I am the innovator of this particular method. So I have innovated this method in the year of 2005. So specifically, and over the period of time, lot of changes happened, lot of upgradations I have done in that. So this is a great method. So it is a in the risk management segment, it is one of the best method you can say, and it is not for the beginners, those who are not known to mathematical way of trading, those who are very you can say uh, new to the trading segment. It is not for them, it is for the people those who have already exposure in the market. They know what is the risk involved in the market. So first we will discuss about the risk. Suppose if I am buying a Bitcoin now, so my simple question, if I say that what are the risks, you will say that downside fall is risk. If I sell Bitcoin now, so what will be the risk, you will say that it may go up, that is my risk. So when it is a falling cycle, I do not know how long it will fall and what extent it will fall and where it will fall. Though I can use some technicals like I have put an indicator here, it is moving average, crossovers and other things. However, I cannot assure, I cannot guarantee that this particular instrument is going to obey this indicator 100%. So that part is not guaranteed, and this particular instrument of Bitcoin has all freedom to go up or come down. So it has all freedom. So this freedom is being granted to this instrument by the market. So we cannot interfere in that. We can calculate, we cannot predict. So always I used to say, whenever you use any method, you do not think that you are predicting, you are just calculating certain things and you are taking a decision based on your wisdom. But that stock or that instrument or that crypto is not binded or bounded to that particular theory what you are following. There is no guarantee that it will follow that particular method and it will never fail you. So this is a fact, this is a truth, whether you accept or not. This is the truth of the market. Anything you buy, it has a downside risk. Anything you sell having a upside risk. So that is a risk of the trade. So now question comes, how to minimize this risk? You cannot nullify the risk. So I do recall here, again I repeat, you cannot nullify the risk to zero and earn money. That is not possible in the capital market or crypto market. You can reduce the risk, reduce. You cannot nullify the risk. So that reduction you can do. So when it comes to the reduction part, so we are talking about the beta. Beta, many of you, those who are investing in mutual fund and other things, it is telling about beta. Many times your financial advisor comes and tells that This is the beta of this portfolio is 1.25. So it is a mathematically they calculate beta of this X portfolio is 1.25. What does it mean? This particular portfolio, if it is linked to particular index, say BTC. So if we are comparing BTC and Ethereum, ETH, so these two is our portfolio. These two is our portfolio. BTC and ETH are portfolio and their beta mathematical calculation beta say 1.75 positive plus 1.75. So how it will, you will read it and how you will understand it as a layman. You will understand this says if this is the beta, so it is a B, one stroke below one line will be there, that is a Greek letter beta. So this particular thing says if Bitcoin is going plus 1%, then Ethereum should move 1.75%. So this is what the beta meaning is. Or over a period of time, if Bitcoin is giving you 10% return, that particular time the Ethereum will give you 17% return. Same as the risk. If in a particular time frame Bitcoin is falling by 10%, then Ethereum also will fall by 17%. So this is what the beta meaning is. Then second part is coming. Some people used to get confused with beta and correlation. Correlation is the probability. So here I have used the term beta. So beta, you know that it is a relationship between the x and y. So the if we are talking about BTC and ETH, Bitcoin and Ethereum. So here Bitcoin and Ethereum, if they are having a 1.75 beta, then I told you if Bitcoin is producing 10% return over a period of time, ETH will give 17.5% return in the same period. But this is not compulsory or this is a rule. The Bitcoin and ETH will obey, there is no guarantee. It is your mathematical calculation. So, but there is no guarantee that whenever Bitcoin has given 10% return, Ethereum will give you 17% return. Ethereum can give 20% return. Ethereum can give 15% return. This is just a mathematical calculation. So whenever there is a deviation comes, so you have expected that Ethereum should give you 17%, Ethereum has given you 15%. So there is a decoupling of minus 2.5% happened. You have expected 17, it has given 10. So you can say there is a minus 7.5% decoupling happened. You have expected 17, it has given you 20. Plus 2.5% decoupling happens. So decoupling is the deviation from its beta proportion or beta effect. That is what called your beta decoupling. So what you expect in terms of beta to deliver, if that instrument does not deliver that, and certainly it will not deliver that. So this is your calculation. So the ETS have no binding on this calculation that it will produce that same result. It will give you the definitely it will produce more or it will produce you less. That factor of excess return production or producing lesser return is known as your beta decoupling. Now question comes, there is another factor called correlation. If I am saying that there is a beta of 1.75 but correlation is 80%, that means the 10% of growth, which is we are expecting 17% growth should come in the ETH, or other words I can say, if BTC is giving you 10% and ETH will give you 17.5%, what is the probability that it will happen? There is a 80% probability it is going to happen. That is correlation. If it is going for 60 correlation, then this return will be produced, but there is a chance that only 60% of accuracy, or there is a chance that 60% this relationship they will obey. That is a probability that this return on a specific period of 17% will be honored by the ETH to the extent of 60% probability. If the same correlation is 40%, you can say that there is a very less chance that ETH is going to follow the same expectation or to give the same expected return like BTC. So very less probability is there, 40% probability is there. So these are the things I have told you in terms of very layman's language, in very simple language, or in the very simplest way to explain beta decoupling. Then it comes to our traders. What as a trader we should do and how we should trade. So it requires lot many things. So here, whenever you are going for the Bitcoin and ETH on this particular subject, on this particular beta decoupling, I have conducted a program on say 6th of January 2025. 6th of January 2025. I have just conducted a program 6th 7th of January. 7th of January, we have a negative beta decoupling. Then I have told that negative decoupling means the buy should be independent, sell should be dependent. So here independent, dependent I will explain. So here ETH is independent and BTC was dependent, and the data taken from the 25th 9 2024, you can take a 90 100 days data, 90 days data, but you can take some 5-6 months data for the crypto. It will be good. More than 100 days data if you take for the crypto, you will get a very good result, but not 500 600 days. So you have to take the number of days should be 100 to 150 days for the crypto. But when we utilize the same thing with the stocks, we are taking 30 60 90, but this is a continuous data, high frequency data, henceforth take some 100 days plus, less than 200 days, 100 plus 200 days below 200, so you can get the actual beta decoupling impact. So January, when we have conducted this event, this particular thing was telling that we should buy the Ethereum and we should sell the BTC. So January, February happened, there is a crash, again March, April. Now if I said I am sitting here, Ethereum has given a great return, and same way this also 10% return we have got. However, Ethereum has given much more return. If we'll change the data points now, maybe the factors should have been changed. So we'll change the data also, and we'll see currently where we are standing. So now beta decoupling you understood in the theoretical terms. What is a beta? What is a decoupling? What is the role of correlations? So all these things you have understood, and we have very simple Excel formulas to do that. So what I'm doing here, everyday basis, whatever the positive returns or negative returns the ETH has given or BTC is being given, on their percentage terms I am calculating. So I am calculating 26th and 25th of September 2024. What is the BTC and ETH BTC's percentage of changes? Means as compared to its previous day, whether it has given a positive return or negative return in terms of percentage I have taken. Same for the BTC. After that, we'll be taking the ln parameters of the previous minus, sorry, ln parameter of current minus previous, and here too also we'll be taking the ln parameter ln square. Bitcoins also same way, ln and ln square will take. Why we are taking this ln and ln square? We want to identify between this Bitcoin and Ethereum who is more volatile, whether Ethereum is more volatile or the whether the Ethereum is more volatile or the Bitcoin is more volatile. So these two factors we are taking. Do remember how many days data minimum required for this crypto? How many days data minimum? Answer it in. Fine. So after this calculation, when we are doing, we are finding out the Ethereum is having an annual volatility of 62% plus, and Bitcoin is having an annual volatility of 44%. So who is having higher volatility? Ethereum. So once Ethereum is having a higher volatility, Ethereum should be taken as a X or independent, and the instrument which is having lower volatility BTC should be taken as a Y or dependent. So this part is over. Based on the volatility, we made a choice who should be independent, who should be dependent. Then to calculate the beta, we required a cluster of 3, 6, 3, 9 and 10 data. So there is a very good formula in Excel 365 available, slope, or else you have to use the covariance and variance, covariance of x and y divided by variance of x. So into n divided by n minus 1, that formula you can utilize, or you can use the slope formula. If slope formula is not available in your Excel, so you have to use covariance of x and y. Here x is Ethereum, y is Bitcoin, divided by variance of x, and multiply it with n divided by n minus 1. So here you are taking 10 divided by 9. N is equal to 10, n minus 1 is 9. So this formula also you can utilize. Both will give you the same value. So 10 days segment, what is the beta? We'll find out. So this particular beta what we are getting, this is applicable for 5th October 2024. This if I can highlight. So this particular beta what we are getting 1.03, this is valid for which day? 5th October 2024. So 5th October 2024, we expect if the whoever is that higher volatility segment, that will be more, because higher volatility instrument will give you more return. So here if a Bitcoin is low, so Bitcoin goes up by 1%, this will give you 1.03%. But effectively what happened, that is very important. So here beta multiple, so we are multiplying with respect to the beta. So what is the beta we are getting here? So here we are getting, so we have expected, so here C is nothing but Ethereum. So Ethereum return minus the beta multiple times of the Ethereum return minus the beta multiple times of the Bitcoin's return, that is your beta decoupling. So we have expected to give positive return, but this has given, this is only 0.01. So we have expected this to also close at 0.01 near, but it has not closed that. So it has given a negative 0.04. So there is a decoupling of 0.05, that scale it has come. In the same period, what is the correlation? Correlation is in percentage term 84%. So there is a say here to give, or there is a probability that both of them will give work in the same path. There is a 84% probability, but still in spite of that, decoupling created. So next day also some decoupling created, next day also some decoupling created. So this decoupling is going on creating every day basis, and we are summing it up. So what is the net decoupling? So we are just summing it off. So you can say here it has extended to 2.96. So wherever my crossor you are finding out, so here, so here, so this is a point that it has, this is a point it has moved to the, this is a point it has moved to the, so total summation till this point, till 14th of October, it has gone to a positive 2.96. If you sum it everything, 2.96 positive it has happened. But suddenly what happens, next day you are seeing that negativity is coming and it is balancing it off. Till 14th of October, it has given a positive decoupling of 2.96. Suddenly something changed on 14th and it is going for negative and balancing. So this positive decoupling means, what does it mean? Positive decoupling means buy dependent, sell independent. So here on this day, 14th of October, if I bought the Bitcoin, same value. So 14th of October, if a Bitcoin is being bought and on the same day, same time, the Ethereum is being sold. This is being sold and Bitcoin is being bought because positive decoupling, dependent bought, independent sell, and equal value. You can say if it is 66,000, you should also multiply it with 25 or 30. So make it $66,000 sell Ethereum and $66,000 buy Bitcoin. If it could have happened, next day it is recoupling. This is coming to -23 and nullifying. So what will be your gain? So you are making 1,000 point, almost 1,000 point gain here, and also you are making 29 points gain here. So by this process, the beta decoupling is recoupling. So beta decoupling is recoupling on this day if you have taken the actions as per the beta decoupling rule. So again it continues, here it bridges, again negative, negative. So we'll be waiting for a factor of 2. So till this point nothing was there. Here again it has come positive. Positive means here too also, here again it has come positive. The date was 20th October 2024. Positive decoupling. Again this should be bought and this should be sold. So you can say the Ethereum should be sold and again the Bitcoin should be bought. Next day again or next couple of days it is recoupling and you are seeing that next day it is recoupling, or so decoupling was there. So this decoupling has again perished and come to a level of saturations, and you can say here again it gives you a chance to negative decoupling of 3.94. So Ethereum should be bought. So here Ethereum should be bought. The date is 25th of October. Ethereum should be bought and Bitcoin should be sold. So this process continues and continues. Why it happens and what makes these things to happen, that is very important to know. These actions, whatever is happening based on the decoupling and the recoupling, why it happens and what makes it to happen, that is very important to know. Why this decoupling happens, why it happens, or what makes it to happen, and why again disappear recoupling happens. Decoupling is a phenomena, or by this process you are calculating and it is a forward indicator. Again I say it's a forward indicator, and you are mathematically calculating what is the demand and supply situation. You are mathematically calculating where which instrument is now in the saturation point of its demand and which instrument is in the saturation point of its supply, between these two, because these two are the very dominant factor in the, you can say, in your crypto domain. In crypto domain, Bitcoin and Ethereum are very dominant because they dominate near to 90% of trade. So here, so ETFs are running on that, exchange traded funds, again investments, lot of things happens. So here they are dominating, this two alone dominates 80% of trade in the crypto market, and that is the reason why this demand and supply, just one day before you are knowing that whether this is +2 -2 level, so you are knowing that the demand is in saturation or the supply is in the saturation. So this process of a positive, so if you have pen and paper, take a note, positive decoupling of +2 above, positive decoupling of +2 above says that the independent, independent is in the saturation point of its demand, and the dependent is in the saturation point of its supply. Means further supply may not happen here. Here demand is that here in the independent is the saturation point of its demand, and this is saturation point of its supply, which is independent. Sorry, dependent is saturation point of its supply, and independent is in the saturation point of its demand. So here whichever is saturated in terms of supply, I will be buying. Whichever is in the saturation point of its supply, demand, I will be selling that. So positive decoupling, X should be bought, sorry, positive decoupling, X should be sell and Y should be buy, and negative ulta, X should be bought and Y should be sell. So understood this part, or anyone has any query, you can ask. Do some data related things. So then first it is in the new data in the top, I want to go it down, so I'll be sorting it the oldest to newest. So it will ask me to expand, sort. So oldest to newest it has happened. I have total 239 data points. I just want the 100. So latest 100, let me take, or 110, whatever is there. So here too also, let me check how many data points I'm using here. So I want to change this data point, make it as a fresh data point. So here, so I have till 106 data points here. So same 106 data points I'll take here too also. Bitcoin, 106 data points I am going to take. So this is the latest one, and 106 data points I will be taking. So it must be, so 106 data points I'll be taking. So to keep the count, I have just, because we are going to use the same data points here, 106, 106, so there will not be any conflict there. So I just copied the data and I am going to paste the same thing here. So let me paste it here. So dates has come, and this is the uh, Bitcoin data. So here I'll be copying it, and always the Bitcoin will be having a lower volatility, no doubt about that. If there is a higher volatility, we can change it. So one data came extra, nothing to worry. We can manage that. So not a issue. So Bitcoin. So let it come to the Y. Now Ethereum data I'll be taking. Ethereum data. Same process. I'll be just sorting this data, and I need oldest to newest, expand the selection, and from there which day I have taken here, let me 13th of May it is being taken, and Ethereum data 13th of May. I'll straight away go to the, so Ethereum data is coming for only July and August came, so we can download it also. So ETH historic data, ETH historic data. So from same source we will take. So I have taken from the investing. I'll be again taking it from the investing. Don't take from the other sources, otherwise it will create the problem. So we require from which date to which date, that particular date will take 13th of May to till date. 13th of May to till date. So I require from 13th of May. So 13th of May 2025 to till date. So this data, and I got the downloaded, and let me open this, and it will be definitely in the opposite order, oldest to newest. So this I have taken it. Now copy this data and paste it in its appropriate section. So we'll get the exact analysis. Now just copy paste, it is done. So here I have pasted it. So this part is done. So one extra data is there. So here we need some calculations. So here I just pull this data, and this particular things also, let me fill it. So it will be lagging with 1. So 107. So 107, wherever it is my calculations are there, I'm just one record. So I'm just editing it till 200 data points I can take. So this is in the Excel. If I am doing, it will have that impacts. So it is almost here, and here sum it off. So it is what it is summing of beta decoupling. Great decoupling is coming here because of the last couple of days of Ethereum movement, but Bitcoin remains silent. Correlation is 95-96%. So it is a not a feasible correlation. So but decoupling has 53, and only last 5 to 3 6 7 days it has added 21. So positive decoupling means positive, and volatility terms, this is 29, this is 78. Ethereum is 78, Bitcoin is 29. So based on this, Bitcoin should be bought, Ethereum should be sold. Based on this principle, currently it says Bitcoin must be bought and Ethereum should be sold in the equal value per person. However, they have a huge difference in terms of volatility. So this is what, how we can add volatility into it. So what we'll do, since Ethereum is highly volatile, so we'll take that ratio. Volatility ratio is 2.65. Means if we are selling Ethereum $100, selling, then we must buy Bitcoin worth $265 USD you can buy. Then only volatility also will balance, as well as your beta decoupling also can be taken care of if you want the volatility to play a role. So here we have taken a 200 days, 100 plus days data. So Ethereum is highly volatile. So you are selling Ethereum, buying the Bitcoin. So if you want, you can hedge, but better You hedge with long-term options, long-term OTM options. So if it is 1 lakh 10, you go for 1 lakh strike put options of December. If it is 4,500, you go with the 5,000 or 5,500 call option of December. So that is also available here in the platform, so that you need not have to re-hedge always. So you will have the time to wait for this trade to mature. So here you have December options, no restrictions, you can buy it in the this thing. And similarly, if you wish to trade, what will be the things? You have to go to the future segment, and then who should be bought? Bitcoin should be bought. How much Bitcoin should be bought? So Bitcoin should be bought $100, means if it is in INR terms, if it is 20,000 worth of Bitcoin you are buying, then you have to reduce the value here. So 20,000 worth of Bitcoin if you are buying, then how much it should be there? 20,000 divided by 2.6. So you can say only 8,000 worth of Ethereum should be sold. ETH should be sold. So if you are buying 20,000 worth of Bitcoin, so if I buy this 20,000 worth of Bitcoin, then I will be selling only 7,000 and odd worth of Ethereum to balance this thing and participate in the beta decoupling logic. But again, I will suggest if it is a small trade, involves a few lakhs, then you can go with without hedge. If it is a bigger trade volume, must hedge both with the December options. So probability, if it is 96, 97, this is not desirable. Very low probability, less than 50, not desirable. Only the probability above 50, below 90 is desirable. So these are the things for the you have seen here. But we have given the software to many of you. So here what happens? Here software, if you go, it gives you that net decoupling. So here different ways the data sets also changes, little refining happens. So Y is Bitcoin, Ethereum is X, so no conflict here. Decoupling 38 it is coming. Volatility ratio 2.6. So correlation again 96, 97%. So in 10 days period, this is the correlation. 15 days period, this is the correlation. 30 days period, this is the correlation. 90 days period, this is the correlation. And this is the overall correlation of the past 200 days. Overall correlation from the past 200 days, it is 96. But these are the clusters, you have different correlation. So you have still the chances. So buying quantity should be 2.6, selling quantity should be 1. $100 if you are selling, $260 you should buy. So this is also beta decoupling taken. Jensen's alpha, Sharpe ratio, Trenner ratio also is being taken here. So here this study also you can get it. So not only with the Bitcoin, Ethereum, we are going with the Bitcoin and the Solana also. So here Bitcoin again Y, Solana is X. So Bitcoin should be bought, Solana should be sold. So same logic here. You have given the Bitcoin and XRP. So here too also you can get the similar kind of things. Bitcoin is very consolidating for a long period of time. So here these pairs we have given, and in the days to come we'll add some more pairs. With Ethereum we'll add some pairs. With Solana we can add some pairs. So that also is already available in the software. So whatever I told in the Excel, similar things is given in the software with much clarity and non-confusing data. So a lot of data is being filtered out there. Some improvements also is being added there. So you can utilize in crypto. Pair trade works better because of high volatility, because pair trade loves high volatility. So high volatility is the friend of pair trade. So higher the volatility, quick you should realize the return. So if you go with the hedging, it is far better. So what happens? Your hedging component also you can keep on swinging and make some quick returns there. So that is also possible, and more the volatility, more accuracy you will get in the pair trade. So only hedging is one parameter you have to very carefully take care of. Anybody, video is uploaded, go through the recordings, and all of you, those who are having the referrals, they are getting the softwares with them. So it is you can take, you can say, you can, whenever you are having. So here net decoupling 38. So every period is having a different uh, values. So you can say, so correlation 96, this 38 comes from different data sets. We are not having you can say I have taken 100 days data, so 106 days data. So software has taken 90 days data, and from there they have estimated maximum 90 days we have taken, and we have given in 10 days frequency 10, 15, 30, 90, maximum 90, 3 months. So that's why that is software is giving you some deviations, because these additions of thing happened in the last 5 to 6 days. So couple of data points the software is taking it out. Maximum 90 days is here. So you follow the software. This is only for presentation purpose. You follow the software. So software you are getting 10, 15, 30. So for 10 days, though here it is unanimous decision that Bitcoin should be bought and the Ethereum should be sold, but sometimes for 15 days sequence it may be different. So 10, 15, 30, 90. So here all segment data segment, it is telling that buy Bitcoin, sell Ethereum. So here selling of Ethereum, and ratio is also maintained the same, but it may not be always. It may not be always. So if you see that a 90-day sequence, the correlation is also 68%. So it may be working for 10 days, but its accuracy, if you keep on holding the trade, it may reduce. 90 days further, it may reduce. So this is also there. So based on the how long you want to hold the trade, based on that only that parameters are given. Very short term 10 days, very long term 90 days. So this all time frames we have given. So if you see the same kind of things, you can say BNB here. You can say though here Bitcoin is not performed, so everywhere you will get the Bitcoin buy, but you can get it here. You can see here. So this is a pair, a SWI. It is telling in 30 days sequence what it is telling. It is telling Y to sell, X to buy. So Y to sell, X to buy. So here Y to buy, BTC is Y. So it is BTC is Y. So Y to buy, X to sell, SWI to be sold for 10 days. 15 days sequence, no changes. But if you want to hold for 30 days, you need to take the different things. You need to buy the SWI and sell the Bitcoin. If your projection is for 30 days, you want to hold the trade. So this is also you can. So here also 90 days. This is changes the sequence. So though short-term decoupling is there, but there is a negative decoupling, 40% negative decoupling. Means whatever the SWI return is there, Bitcoin's returns are different. So no way they are matching with each other, but there is a correlation exists also. So for that reason only, you have to see this parameter. How long you used to hold the trade in during that period, it is there. If your trade is more than 15 days and you are not getting the result, but 30 days sequence it is changing, so better to come out of the trade. So that is what the software says. The recordings have been processed. I will be putting in the YouTube. You can watch it, and also I will alert in the group. So thank you very much, and good night to all of you.